Hi everyone, thank you for joining us for today's webinar. For those that just joined us, we'll be starting the webinar shortly. Let's just wait a few moments for the rest to join us before we start. Thank you. All right, we shall not wait any longer. Let's begin our webinar. Once again, thank you for joining us for today's webinar. I'm Casman, the Chief Operating Officer of Kairos. I'm the host for today. Today, we have Jeffrey Koo, our Chief Executive Officer, will be sharing with you on Parametric Insurance. He's a renowned figure in the parametric insurance space. So without further ado, let's welcome Jeffrey on stage. Jeffrey, please.
Parametric insurance, an overview. The next slide. So what is parametric insurance? It's been around for many, many years, right? As compared to, say, traditional insurance, which pays for losses that are caused by an insured event, right? That's traditional insurance. For example, you have a car accident or there's a property loss. That will be basically traditional insurance, where there will be a loss adjuster coming in and checking, and then from down there, a payout, that is agreed upon, right? Parametric insurance works differently, right? It is paid upon hitting a triggering event. This can, in many cases, be a weather event, or it can be even yield data. And it's a fixed amount, right? That's paid out. So it's not you don't have to argue the amount and all that. Once the trigger is hit, it is paid out. Importantly, there's no loss adjusting. Nobody goes in, or let's say, for example, you have a car accident and you don't have to bring it to a shop to take a look and all that. There's no loss adjuster involved. The payout depends basically on the data, right? So if there's weather data and it's triggered, it reaches a certain value, it pays out. So when the pre-agreed threshold is met, policy is triggered, payout occurs, right? So parametric trigger is variable. So common use ones will be the natural catastrophe ones, like, is it a Cat 1 typhoon, Cat 2 typhoon, or when it comes to, let's say, earthquakes, right? On a Richter scale, right? So you can use the Richter scale and use that as a reference point for payout. Now, the main thing and the most important thing to remember about parametric insurance is to protect cash flow of a company, right? So if you're a company and you need cash back quickly to recover from the losses of an event, parametric insurance is the product for you, right? Next slide, please. Now the data, as I mentioned earlier, has to come from third-party sources. It cannot be from the client or even from the insurer or even from us. It has to be actually neutral party data. The data must be also publicly available, right? So because of this, you're using neutral party data. You don't have much disputes, right? You don't have much chance of actually moral hazard. Then, of course, this particular trigger, be it category 3 typhoon and a payout, this is all discussed beforehand and it's put actually on the policy wording before even the start of the cover, right? So, for example, a hurricane cover is triggered by wind speed reaching a certain pre-agreed intensity, for example, 250 kilometers per hour, right? So, only and only if the weather station in that location registers to 250 kilometers per hour, then the payout happen. If not, it won't, right? So, of course, we have to verify the quality of this data and the weather station and so on, right? Another possibility is, of course, earthquake can be triggered by seismic intensity, how much ground shaking there is, right? So we can pre-agree on that for a particular location. Next slide, please. So how does parametric insurance work, right? So let's go to indemnity first, the one below, right? That's basically the traditional one. So the insured, will come to the insurer or the broker and say, hey, look, I have this loss. I like to claim for it. And you have to describe the loss. What happens is that insurer will send in the loss adjuster to take a look. Say, for example, it's a forest and it's a forest fire. They'll send a group of assessors to take a look, and to really check whether this fire was naturally caused or was it a moral hazard kind of fire where the owner actually set fire to it himself. So all these things they have to go through, and after that, a review is done as the losses. The review is done on losses, and from there, possibly there's some dispute to say, hey, you should be paying that or not paying that. So this entire exercise can last anywhere between 1 month if it's a small loss, or maybe up to a year, or maybe never if it hits the courts. Now, for parametric insurance, it's different. We pre-agree as a certain wind speed or certain temperature. Once it hits, you'll pay out within probably anywhere between 3 to 4 weeks. So it's very quick. It's a very quick turnaround. Okay, next. Now, why parametric insurance, right? Insurance is big. There are a lot of people talking about it, and slowly and steadily, more countries and large corporates are using this because of climate change. I give you a very simple example. In the US, there are certain areas that are uninsurable. Homeowners cannot buy a cover for a simple reason is that the natural catastrophe there happens too often and is too serious. So parametric insurance can cover this kind of cost. Of course, the premiums will be higher, but they can go in and offer a certain cover to say that, look, if the typhoon hits your place, there'll be a certain amount of payout. Now, naturally speaking, the premiums will not be as low as a normal property insurance of maybe 0.5 and all that, but there's still possibility of a cover, right? Then the protection gap, in many cases, for example, you own a hotel and then there's a heavy rain or flooding for maybe 1 week, it will definitely affect, the number of people visiting your hotel, your client base, the amount will drop. You need to get back some of that money, right? So that gap will be covered by parametric insurance. For example, in Singapore, a very interesting one where the marketing plan was for I think it's International Hotel Group. If you stayed in the junior suite for for a few days, and during that period of time there was a lot of heavy rain, you'd be getting a free room another time, right? So similarly, it's based on the trigger, right? The third point is supply chain disruptions. If you are, for example, somebody who's actually building, let's say, a skyscraper and all that, and you need all the concrete, steel, and all that has to be brought in for you to build this skyscraper. What happens if there's a typhoon or there's heavy rainfall that disrupts the logistics of bringing these things in? It will impact you from handing over the keys to the owner on the right time, right? So supply chain disruptions. Lastly, of course, there's the tightening of the insurance market, which I mentioned earlier. Insurers, the more traditional ones, don't want to use traditional insurance to cover these kinds of losses. So parametric insurance has to come in. Next, please. Now, what else, right? Liquidity management is high on priority list in many companies. They want the money to come back quickly. They do not want the money to be spent on lawyers trying to work out how much they get paid and all that. So money to come back quickly. If not, the company can go bankrupt. There's a shift from purely physical to intangible assets, as I mentioned earlier on. The hotel, for example, there's a heavy rain. The hotel will still be there. It will not be impacted. The property cover will not trigger, but they'll lose money, right? So the intangible assets can be covered, right? So again, risk with interconnected supply chains, right? Traditional insurance leaves this gap and parametric can come in, right? So you need a solution to blend together with it to supplement it. So structuring it is important to make sure that it's affordable. And of course, it makes sense with the loss history. Next. There's increase in resilience to help companies recover, as mentioned earlier on. It provides coverage for a changing environment. I'm sure now you read the news, temperatures are 40 over degrees sometimes. That definitely impacts business. Suddenly, there's heavy rainfall, floods here and there. So all these kinds of risks can be insured using parametric insurance. And to be frank, it's not something that's exotic. It's been around for 10, 20 odd years. Those traders, those people that are doing, for example, into the agriculture business, they do a lot of this called weather derivatives. So it's similar in fashion, except we use insurance paper for it, right? Next. So what do you need actually in parametric insurance? You need a few parts of it. The first part is the limit. Basically, how much, maybe the slide before this, maybe how much you need to insure, right? So for example, the building is worth $1 million, but your business is, let's say, worth $500,000 for the entire year. So you need to insure 1.5 million. A pure property cover cannot cover the extra 0.5 million, right? Predefined event trigger, you got to agree and you got to do some research to find out what is the trigger that will cause you have these losses. A predefined proxy, that means you use an index, be it a weather station or be it, let's say, in terms of your solar plant and not enough sunlight, then you have to use maybe even satellite data for this, right? And of course, end of the day, insurable interest. This is not for gambling. At the end of the day, there must be an insurable interest. Somebody has to get a loss, and therefore you have to buy this cover. Okay, so let's go to the first one is the limit. The limit is the important part here compared to a normal insurance where the limit can only be the cost of what is insured. Parametric insurance allows you to actually have a higher limit. Be it the value of your building is 1 million, you can even ask for cover for 10 million. No problem. But of course, you got to pay the premium that comes with it. Okay. Next, the trigger. Now, the trigger has to be something that is not manipulable, right? It has to happen by chance, right? It must be fortuitous, right? It must be independent and neutral. Nobody can, sort of play with it so that it triggers before the event. And the available data must have a long history. I've dealt with many where they say, look, I got my own weather station, but the problem is the weather station was only built for 2 years, so the data is not enough to actually work out a price, right? Natural catastrophes are usually very commonly used as covers, right? So you got a lot of more exotic stuff like crop yields, uh, you know, power outages data. All of this can be used for parametric insurance. Next, please. Next slide. Yeah. So the payout, right? The payout is also an interesting thing. It can be a digital payout or it can be a linear payout. Let me explain. Digital payout, there's immediately payout, which means that, example, the wind speed was 250 kilometers per hour. When it hits, that's it. It pays out at 250 kilometers per hour. Anything before that, because the wind speed of 200 kilometers per hour, no payout. Another way is to do it linearly. That means at 180 kilometers per hour, a little bit of payout. 200, a little bit of payout. 220, a bit of payout. And 250 manner also. Or even not really linear, but maybe a little payout at the beginning of 180 and then the full payout at 250. So that's possible to structure that way, right? Next. Next slide. Okay, so this example, 5 million payout, US dollar payout, if a category 3 typhoon hits, right? So there's immediate payout. And then linear payout, for example, rainfall, right? It's based on cumulative amount of rainfall before a flood happens. So 10 mm, $10,000 for every millimeter of cumulative rainfall before it hits a certain threshold, right? The key advantage of it, right, is independent of any physical assets, right? It provides cover for all those intangible parts, your business and all that. Particularly, no loss assessment is quick, right? It's transparent, right? The data is seen by you and the client and the insurer. There's no way to sort of manipulate it, right? So it provides the insured, again, importantly, liquidity. Next slide. The difference between the two, I'll go here quickly. Now, for the trigger, the traditional one would be cause real losses, right? What are the losses? You've got to physically know what they are. Parametric, it just based on the index, right? The index of weather station, what's the trigger, it pays out. The reimbursement for traditional is usually through a loss adjusting. For parametric, it hits, it pays. There is basis risk in traditional insurance because your policy wording may miss out certain things. There's also basis risk in parametric insurance, which means that, for example, you buy a cover that's for 250 kilometers per hour wind speed, but too bad, at 200 kilometers per hour, all your buildings are knocked down. So it doesn't match. There's a basis risk there. So you need to buy a cover that actually matches your loss history. Loss assessment, again, no loss assessment for parametric. Traditional, you've got to go through the process of a lot assessors and all that to come in, right? Next slide. Now, the term traditional is usually 1 year. Parametric, usually it is a shorter period of time. It can be multi-year, but of course, with multi-year, you're looking at the crystal ball in the future is going to cost more money. Huh? Structure, traditional is standard. Your policy wordings are usually the Lloyd's policy wording, very standard policy wordings for property, casualty. For parametric, they are all actually done tailor-made. The form is usually for traditional is insurance contract, and whereas for that in parametric, it is also insurance, and sometimes it is a derivative, but we won't talk about that today, right? Next. Now, how does Kairos come in? For example, now we already have ongoing relationship with a Thai company. We'll be representing them soon. So we'll talk more about this in the future. Now, I'd like to actually take this opportunity to hand over the time to my colleague, Andre.
All right. Okay. Thank you, Jeff. Good afternoon, everyone. I'm Andre, the CTO of Kairos. Now that Jeffrey has explained the parametric insurance, now it's my turn to explain how we help you through technology. So on this slide, I'll show how we transform raw data into actionable insights for accurate risk assessments. Okay. So first part there on the left, you see data collection. So we at Kairos, we gather huge amounts of historical weather data from sources like weather stations, satellites, and this includes data like temperature, wind speed, rainfall over extensive periods of time. And by using diverse and reliable sources, we ensure a comprehensive data set. Then we move to data storage. So all of these collected data is securely stored in our scalable cloud-based infrastructure. And our system ensures that data is secure and easily accessible. And we structure and index the data for easy retrieval and analysis. Which brings me to the third stage, which is data analysis. So we have tools, and through our tools and consultancy, you can analyze this data to identify patterns and correlations. And our advanced analytics will transform these raw numbers into meaningful insights, which will then help you understand the trends and the risks. And finally, the risk assessment. And you can use the analyzed data that I mentioned before to enhance your risk models. This improves the precisions of your assessments, which allows for accurate pricing and customized insurance products. So with better risk assessments, you can confidently manage and mitigate potential risks. So in short, our technology-driven approach transforms raw data into actionable insights, which is critical for precise risk management and helps you improve your parametric insurance offerings. So with that, I thank you for your attention. If you have any questions or want to know more, feel free to reach out.
All right. Thank you, Andre. All right. With that, we come to the end of our webinar. If you have any questions, feel free to write an email to us at admin@kairosrs.com. I repeat, our email is admin@kairosrs.com. Okay, as you can see from this slides itself, there's a QR code. We have a webinar that's coming out on the 11th of July. That is 2 days away at 4 p.m. Singapore time on trade credit insurance and banking solutions. So if you're interested for this webinar, do register by scanning the QR code here. All right, I will leave the slide here for a few moments. With that, I hope you have a better understanding for today's webinar on parametric insurance. Okay, and of course, how Kairos actually can help you with that. Thank you, and I hope you have a wonderful day. Thank you. Bye.
Okay.
Thank you. Bye.
Thank you.